In market news now, Asian shares were mostly lower as traders assessed a mixed U.S. jobs report for clues on the Federal Reserve's next decision. The intensifying Ukraine-Russia conflict is also weighing on sentiment. Meanwhile, Chinese blue chip stocks eased 0.7%, with investors still disappointed at the lack of major and concrete stimulus steps from Beijing. Meanwhile, with about 90% of S&P 500 earnings reported, results are 4% better than consensus estimates, with more than 79% of companies beating expectations. This week, we're expecting earnings from Walt Disney. Oil is steady after Ukraine attacked another Russian vessel over the weekend, a signal of a rapidly expanding war that puts at risk significant flows of Russia's commodities from the Black Sea. However, to talk to us about the latest when it comes to the markets, we are joined by Gary Boyson from Rand Swiss. Gary, thank you so much for your time. How are you characterizing global and local market sentiment, and what's driving that?
Well, you still feel that the market is fairly greedy. So if you look at, one where the S&P 500 index is, for example, we're about 6% off all-time highs. If you look at something like the volatility index, which is a good gauge of, I suppose, fear and greed, people call it the fear and greed index, we're sitting just a touch below 17. That's up from around 1350. So you are seeing a little bit of nervousness starting to creep into the markets. But overall, I think that the sentiment is still fairly positive. You can look at all sorts of different measures. So you can look at, let's say, the spread between junk bonds and investment grade bonds. And that's still saying that people are pretty optimistic about higher equity markets in spite of high interest rates and the solid run up that we've seen in underlying equity prices so far. So the sentiment for me is still fairly bullish on the market. People feeling a little bit greedy, maybe a good time to take a little bit of money off the table, actually.
When you look back at last week, what would you say was one of the dominant factors behind the moves that we saw in U.S. bond markets?
So we've seen U.S. bond yields starting to spike higher, and there's a couple of factors to this. A lot of people are pointing to the idea that Fitch downgraded the U.S. credit rating. Obviously, when you have increased risk around an economy, or where you have, I suppose, a ratings agency like that saying that you're no longer a AAA borrower, that should have an impact on bond yields. But the narrative around it really has been that rating change is maybe a little strange, and it's doesn't represent new financial data. And the actual move in the US bond yields actually came from the idea that the US government was going to borrow more, and that they were basically lifting their issuance targets. So if the US is going to borrow a little bit more, that means that there's, I suppose, more securities in the market, and that could push up the yield slightly. The other big factor is the idea that we might just see a soft landing in the US. And this is a narrative that the Fed has been pushing, saying that, yes, it's against the historical record, but the idea that you might not see a much weaker labor market, you might not see 2 consecutive quarters of negative GDP growth, so you might not see the US falling into a recession. And if that's the case, you may see the Fed leaving interest rates higher for a little bit longer, and that's just starting to lift the long end of the curve. So obviously that let's say if you look at the 10-year Treasury rate, it's hitting 9-month highs. It was around 4.19%. Today it's pulled down to around 4.11%. So it has moderated slightly, but definitely still elevated.
So when you factor in the Federal Reserve's shift to data dependence going forward, and the fact that perhaps we could see even more increased sensitivity, especially with a lot of data coming through between now and September, we've got US CPI coming out on Thursday. What's the expectation? What are we looking for?
I think the US CPI number is going to be absolutely massive. Everyone is looking to see, how this very aggressive, very quick interest rate hiking cycle is going to feed into underlying pricing. So, the expectation is that the headline number, so the headline year-on-year increase in US prices is going to be around 3.3%. So that's actually up from the 3% print we had last time around. But we are going to see a moderation in the core number, so excluding food prices and energy. So There, the previous print on the year-on-year figure was 4.8%. We're expecting 4.7%. And this is going to be absolutely key, because we have to see inflation coming down in order to see some relief, to see interest rates and I suppose the price of money coming down. So that's the expectation. We should have the numbers out this Thursday, and it's definitely going to be market moving. If we see a big change from those expectations, it's going to push financial market prices around.
Just quickly before we wrap, have you thought about whether the Fed can live with an interest rate just slightly above 2%?
It's a good question, and I'm really not sure. So if you look at it, the Fed has been very focused on getting back to 2%. That's the exact wording that they use. They say we are very focused on getting back to that 2% target. And the reason that they have for that is that inflation really impacts low-income houses far more than high-income houses. So the idea of lifting interest rates and tackling inflation is very, very key for them, just from, I suppose, a political point of view as well. So will they buckle early? It's anyone's guess, but it's so important for them to anchor those inflation expectations. I would assume that you have to take the 2% target seriously.
All right, Gary, thank you so much for your time. That is Gary Boyson, who is portfolio manager at Rand Swiss. Well, we're going to be handing over to Francis right now. Stay tuned for that.